for April 1st, 2016. Happy April, everyone. Diane, would you please call the roll?
Yes, Chair.
Here.
Controller's Office.
Here.
Public Advocate's Office.
Here.
Borough President Manhattan. Borough President Brooklyn.
Present.
Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx. International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37.
Here.
We have a quorum.
Great. Okay, so Scott, I'll turn it over to you.
Okay, thanks very much. The third meeting in a series on asset allocation with a focus on private assets and their incremental effect on the portfolio. As requested, the folks at Callan have given some thought to the questions that you all had about different pairings. I have asked them to look at another pairing if we get to it, and so we'll hand it out if appropriate, so that we can really look through this process. But I'm going to turn it over now to Callan, to Bud, and the team to take us through the work that they've done in answer to your questions.
Thanks, Scott. Good morning, everyone.
Morning.
So in front of you, you should have two presentations. One is the one for today, April 1st, 2016 presentation. And then also we included the copy of the last presentation in case there's questions you can refer back to from the March 7th presentation. So unfortunately, Jim Van Hewitt could not be here in person, but he is on the phone. Jim, can you hear us?
Yeah, I can hear you very well. Thank you, Bud.
You should identify himself verbally to the stenographer.
Jim Van Hewitt.
No, he needs to say it.
Jim, please identify
Oh,
yourself.
this is Jim Van Hewitt with Callan Associates.
Great. So, as Scott pointed out, in the April 1st presentation, we have gone through a number of new iterations that you requested at the last meeting that really affect the private assets and their effect on the portfolio. So at this point, I'm going to turn it over to Jim and walk you through the April 1st presentation.
Good. Thank you, Bud. As I pointed out, yes, this is the April 1st presentation, and beginning on slide 1, the second bullet point notes asset allocations we evaluated in this particular presentation. They included eliminating hedge funds, which we evaluated earlier, although we have a modestly different take on it this time. Then we went and eliminated private equity, but kept hedge funds. Then we eliminated both private equity and hedge funds. And then finally, recognizing that we already have private equity investments that are going to be with the fund for the foreseeable future, we constrained the allocation to private equity to just 5%, rather than the existing target of 6.9. We compared all of these to the base mix 3, which we showed you earlier. And to kind of summarize some of the differences, the return differences again are small. If you recall, when we eliminated hedge funds earlier, there was a very small difference in return. There's nothing really different when we eliminate private equity or private equity and hedge funds. And one of the things that means is that should you choose to select one of these asset allocations to reach the 7% target return, there would only be modest, very modest changes in the allocation. So these would be very close to what you would select if you wanted to have as an objective reaching the 7% target return. Because we focused on, I'm sorry, was there a question?
No.
Okay. Because we focused on the 7% target return mixes, we were able to summarize all of these on a single slide, which is slide 2, which makes the comparison, I think, pretty convenient. And then before I get to that slide, I'll just make some overall observations, and that's that, again, as I mentioned before, limiting or eliminating a single or two asset classes, alternative asset classes, doesn't have a huge impact on return in this type of analysis. But this type of analysis is really designed to say, how do we construct the most diversified portfolio rather than how much return does any given asset class add to the portfolio. There are really other better ways of looking at how much extra return you can get from hedge funds and private equity and so forth. Really what optimization does is say, how do we best diversify the portfolio? So the fact that the return differences are very substantial between the asset mixes is not a surprise and should not be used to say that these asset mixes don't, or excuse me, these alternative asset classes don't contribute to the return of the portfolio.
And Jim, wouldn't you also say that what you just expressed is because we're looking at a 10-year time horizon? If we were looking at only a 1-year time horizon, it would have a bigger effect.
Yeah, that's absolutely true. In any given year, let's say when public equity is out of favor, hedge funds are likely to be much more in favor and contribute, not only more than the average that we would expect. I mean, not only more than what's being shown here, but also more than the average that we would expect over that 10-year time horizon. So in any given year, the impact of an alternative investment can be very substantial.
And Jim, this is Scott. Just to confirm, and this refers to the thing that I had them run. At the 1 decimal point level, it doesn't really matter which of the private asset classes you take out in the analysis. If we were to take out real estate and infrastructure in the same analysis, at a 1 decimal point rate, you'd have pretty much the same result, 6.9% return and about the same standard deviation, correct?
Yes, I would certainly agree with that. That regardless of the alternative asset class that you take out, the impact on return in this mean variance analysis is not very substantial.
Right. And so there's not a greater free lunch in taking these particular asset classes out of the mix than any other asset class. So we're pretty indifferent. It's more asset classes gives you greater diversification, and having a broad selection of alternative asset classes brings down the risk level for any level of return, increases the return for any level of risk. Do you agree with that statement?
Absolutely.
Thank you.
And Jim will get into some further in terms of the free lunch. Taking out asset classes means that you have to have higher concentrations, in the remaining asset classes. So if you take out hedge funds and private equity, given this, you have to have a lot more public equity.
Yeah, I mean, you can see from the mixes here, you begin to rely a lot more on international equity, particularly emerging markets equity, which have their own sets of risks.
Any question?
Yep.
If one were to remove those alternatives and then invest more dollars in stocks, equities, does that raise the risk list?
Yeah, and that's the original analysis we showed you. If you remember, we showed you the low-cost mix, and I think we have it in this previous test. So low-cost mix just means no alternatives. Let's take the alternatives out altogether. Anything with a carry, promote, performance fee, all of the private asset classes. So let's just say we don't pay those fees, but that's not what we do here. What kind of portfolio could we construct for you? And that was the low-cost portfolio. We can get to the same return with a little bit more risk. And then Sherry showed you over a 10-year period, what would that extra risk mean in an out scenario? It would mean that you would have more contributions if you had a really nasty 5 years, and Sherry showed you how much. It also means that if you had a really great 5 years, you'd have a lot more returns. So with the no alternatives mix, you have a higher upside and higher downside. And the question for the board is, if you start with the case that we don't like alternatives, we don't like these fees, can you live with the volatility and the fact that you have some likelihood that you'd have more to pay over time. On average, you'd pay about the same.
And remember that the last time we did the asset allocation study, we were trying to get away from that because we were relying too much on public equity, and we weren't comfortable with that level of volatility.
So I have two questions. The first question is, since particularly in hedge funds, you said that this is an analysis that will over 10 years. We haven't been investing in hedge funds for 10 years. So are you taking years that we have not been investing?
This is forward-looking.
So you're projecting what the return of a hedge fund will be 10 years from now?
Yes, it's an expectation. We do that for each one of the asset classes.
I appreciate that. You're very, very person. The second thing is the issue of, and this is part of what I want to say. On the one hand, I hear that the alternative asset class that we've invested in this hedge funds is too small. It doesn't make, well, not too small. That is really, we want to have a large impact on the portfolio because in reality it's a small part of the bigger portfolio. And on the other hand, I hear, well, if you eliminate this asset class, and I'm talking specifically about hedge funds, then you're increasing risk. I don't understand that statement. I mean, and the reason is I understand the principle of diversification, but I also understand the principle that if a particular asset class is not doing well, that's what this board does. We readjust to the reality of what we have as funds. I mean, I think if we all knew exactly how one fund will do, we don't have that, and I don't quite understand that.
So let me. I'm sorry, but we're addressing it together. Do you want to take it? I'm
Sure.
happy to answer this one.
Sure. Well, I think that is what we're trying to achieve here, is to decide as a board what asset classes you want to be invested in going forward. And what we've tried to show you here is what it would look like based on our expectations for each asset class, what your expected return would be over the next 10 years. And you can achieve that by not investing in some asset classes like hedge funds, by investing more in the other asset classes.
So you don't, as the analysis shows, you don't take on a lot more risk, Henry, if you just eliminate hedge funds on an incremental basis. About, analytically, the portfolio looks similar. It looks similar because you go and you take that money that you took out of hedge funds and you put it in stocks. And when you balance them out, it's not much difference in the expected return or the expected risk. The second part of what you said about evaluating if an asset class is done poorly, evaluating and selling it, I would argue, I would take exception with that. I think you want to do just the opposite. Unless you think something that has happened to an asset class is going to change its long-term relative return relative to other asset classes. When the asset class underperforms, you want to invest more money. And when the asset class outperforms, you want to invest less money. It's called rebalancing and counter-cyclical rebalancing. And it is proven to be one of the most tried and true ways to, for any asset allocation group, for a trustee group or any asset allocation group, to keep to the long-term expected returns of the portfolio. The trouble with it is if you're wrong and you've misdiagnosed what the relative returns are going to be, you're throwing good money after bad. And it's very difficult emotionally for any human being to give more money to things that have done poorly and take money away from things that have done well. It's perhaps the most difficult thing in finance. And that's why we have sort of automated rebalancing to keep us from that human behavior. And it's a well-accepted principle in financial economics that the solution to this, natural behavior is rebalancing, and that is what we practice here.
So I have a question. In your commentary later in the presentations, you talk about an optimal allocation in terms of equity of 60% US and 40% non-US. So on page 4, for example, of the current deck, today's deck, and this is the discussion about the base 3 without hedge funds, but I think all the alternative allocations, it talks about this. The optimal allocation of about 60% U.S. equity and 40% non-U.S. That's under the second round bullet point. And the only one that actually achieves that, I think, is the base 3 without hedge funds or private equity, because we free up so much room in the basket by eliminating both of those, then we could get to this optimal allocation. So I'm trying to understand Callan's perspective on the optimal allocation and what the value of that is. And what are we at right now in terms of U.S. versus non-U.S.? I guess that's up
Yeah,
here.
it's on the current chart on page 2.
Yeah. Split is wrong.
So it's about 31.6 in U.S. and 32.6. 16.9 in international.
What's international? Well, yeah, but you have to add emerging markets too, right?
Yeah.
That's 16.9.
Well, we're not at 12.7 and 4.2 right now. Like I think we have a split that is not up to the ACWI ex-US. It is, because that's 85-15, and we're not there yet. Like I think we're closer to 60-40 split between.
That's correct. This is this is the market target.
Yeah, that's the market.
Yeah.
Right,
So in
but
terms of the-
we're not talking right now about the emerging markets versus emerging markets, talking about U.S. versus international. So that looks to be about, currently about 2 to 1, about roughly 2/3 U.S., 1/3.
Right, so there's two things here. One is, when we think about the optimal allocation,
Yeah.
US versus non-US, it is more of a market weight. When you think about the world capitalization
Mhm.
using a global benchmark, it is about 60-40.
Okay.
And so unless there's a reason why you want to take a stand away from the global market, you would do what the capitalization-based benchmark is telling you.
And really the reason for us to do that is because the basket constrains us.
That's correct.
Right.
The basket is constraining us on non-US.
So any removal of things that are in the basket would free it up, right? So when you, this is why we did the experiment, what happens if we take real estate and infrastructure out? Not that we're arguing we should do it, but just to be able to
But
compare.
real estate, is all of real estate in the basket, or is it just,
Real estate above
10%.
above 10%.
Right.
Yeah.
So really, real estate-
Infrastructure, I think, all goes in the basket for some strange reason, but, yeah.
so our real estate is
You
below
do get a
10%.
free pass to 10%.
Right.
You're right, yeah.
Right, okay. So real estate doesn't, at least none of these
Yeah,
allocations.
I don't know what the thing shows, but it would, you know,
Yeah.
to the extent that you're over the 10%, it would free, it would free it up.
So I guess I would like Callan's view on, what the value is of getting closer to that optimal allocation in the global equity versus not, I guess.
Jim, do you want to address that?
Yeah, sure, I'd be happy to. We think that there's more value added in using the basket for the alternative asset classes than there is in having a more optimal mix between U.S. and non-U.S. stocks that we would have in the absence of asset costs. So alternative investments are more important than the mix within the public equity portfolio.
Mm-hmm. Okay. And basically because you feel like the risk-adjusted return from the alternatives outweighs the risk-adjusted return from increasing international exposure.
Both the improvement in the risk-adjusted returns and, as we discussed earlier, the improvement in the diversification of the portfolio. While having international stocks certainly diversifies U.S. stocks, they're both still public equity, and we think that things like private equity and hedge funds and real estate are differentiated asset classes that add further diversification to the portfolio.
If you think about correlation in addition to risk return, that when we're going to mean variance, it's going to,
Okay,
that's part of our belief.
I want to ask one more question. And so it's really about hedging, and this, for most of the people on the board were not able to make the meeting on Wednesday at BAM regarding the composition of our fixed income portfolio. And I guess I would like Callan to explain your position in terms of hedging the equity risk that are, that is built into our portfolio, because, if we're taking on a lot of equity risk, which we clearly are, no matter what asset allocation we decide, what's your view on the best approach to hedging that risk, which is sort of one of the main purposes of the allocation to fixed income?
If you want to take 5 minutes to summarize your presentation from Wednesday?
Sure, I'd be happy to. And actually, I think I can answer the question directly. We want to diversify as much as we can. And so that involves, I think, two aspects that we've already addressed this morning. One of which is kind of the long-term correlation. Over normal markets, are different asset classes moving together up and down, or are they moving countercyclically? And so we want them generally to move countercyclically over long periods of time. But as Bud pointed out, there's another aspect to this as well, and that's how they move over short periods of time. And we want to make sure that when there are extremes of one market, that there's likely to be, and I hesitate to use the word hedge, because hedges tend to imply a guarantee that there'll be offsetting returns, but they're likely to be offsetting returns. And then the third aspect of this is, if you, for this amount of counterbalancing of returns, how much are you willing to pay? And in terms of the fixed income allocation, the payment is not direct. I'm not talking about the fees that you pay to the managers. I'm talking about the return that you give up by not investing in a more, in a higher returning asset class. And the discussion that we had on Wednesday concerned whether to have a more core market-like bond portfolio, as is in place now, or to have more, if not all, long-term treasuries in that portfolio. And our position was that it's probably best to have a more core-like portfolio for a couple of reasons. Number one, the counter-cyclicality of the long treasury portfolio with equities doesn't always occur. And number two, the risk of the long-term treasury portfolio we thought was too much of the potential for losses was too much of a price to pay for the potential counter-cyclicality. And to summarize that argument, basically there's a lot of volatility in long-term treasuries. The long-term treasury volatility is close to an S&P 500 type of volatility, number one. And number two, I think that most all forecasters are saying that there will be an increase in interest rates. That the timing and the amount of that increase is subject to debate, but it's highly likely that we'll see an increase in interest rates. And a longer-term portfolio has more sensitivity to that increase in interest rates, and that sensitivity is negative. So if interest rates go up, you have a core bond portfolio, go into a long treasury portfolio, you're going to lose, on the order of 3 times as much in that long treasury portfolio. We like the diversification of long treasuries. We understand the argument for it, but there's uncertainty involved, and we think that the implicit cost of going to long treasuries is too high.
Thanks.
Shall we continue with the presentation?
Yes, please start.
Jim, do you want to start with the commentary on each one?
Yeah, that sounds great. Actually, the mixes themselves are on slide 2. I am going to go over everything that's on the subsequent pages, which is all text. So if you want to focus on slide 2, I'm going to cover everything else that's involved here. Feel free to look at those other slides, but I'm going to tell you pretty much what they say. So what we did on slide 2 is, as I mentioned before, we compared the impact of eliminating different alternative investments with phase 3, which is the portfolio that returns your 7% target, including all of the alternative investments. The first one next to phase 3, the first alternative allocation, is the no hedge fund 3. So this was the 7% targeted mix, or close to 7% targeted mix, with no hedge funds. This looks a little bit different from the one that we saw a few weeks ago when we talked about this. And as much as you remember that eliminating hedge funds then led to a 2 basis point reduction in return for the same level of risk for that 13.79 standard deviation. And this one now has 4. And I wanted to explain that up front. If you'll remember, one of the other questions that we addressed last time was what would happen if we limited the real estate allocation to 7.5. And we showed you the impact. The impact was really not very substantial, both in terms of the optimization and we felt from a practical basis. So what we did was we implemented that 7.5% limitation on real estate for all of these alternative mixes. And if some of the assets that flow out of the hedge funds by eliminating the hedge funds are not permitted to flow into real estate, there was a minor additional reduction in returns. But recognize that's just from 6.98 to 6.96. The additional real estate allocation, or the allocation that we didn't make to real estate, ended up in a higher allocation to equity, which was partly offset by some changes in fixed income to achieve that 13.79% standard deviation. So lastly, if you eliminate hedge funds, you have this 4 basis point difference in return. The assets move primarily to equities with only about half a percentage point allocation increase to core fixed income. The second alternative that we looked at was the elimination of private equity. And that's the no PE3 that's right there in the center of the table. And if you look, you see that for approximately the same standard deviation, given all the constraints that are involved, we hit 13.79 precisely, but we hit 13.78. You can see that there's only a 1% reduction in return. Now, given the discussions that we've had before about the impact on returns and the constraint of mean variance optimization in terms of showing the value added, I want to emphasize all those arguments again, that the indication that there's only a 1 basis point reduction in risk is not an indication that private equity isn't a valuable contributor to the portfolio. It looks like it contributes less than hedge funds because there's a smaller reduction in return. But in fact, the hedge fund expectation was one that we had worked with NYCERS with BAM on to reflect the characteristics of the band portfolio, this is the straight Callan expectation for private equity. And we use the Callan expectation for hedge funds. The return difference, or the return reduction would be similar to this, would probably be to 6.98 or 6.99. But again, the mean variance optimization tells you how to diversify a portfolio. It doesn't tell you how much value added is contributed by each of the components. And in terms of the diversification or the structure of the portfolio, the information that we get from this no private equity 3 allocation is that if you eliminate private equity, what happens is that the public equity increases substantially. As a matter of fact, in this case, it increases by over 11%. And the reason for that is that private equity contributes a lot of return to the portfolio. In order to make up that return, you not only have to replace the 6.9% that we took out of private equity, but you have to replace more than that in order to move up in terms of return. And the additional equity is sourced from the fixed income portfolio. And the reason for that is that while private equity contributes a lot in terms of return, it also contributes a lot in terms of risk. So if you add private equity to the portfolio, you need to add more fixed income, more of a lower volatility, low correlation asset class to offset the volatility of private equity. Conversely, if you eliminate private equity, you no longer need that extra allocation to fixed income, and so therefore that goes into equity to keep the return high.
So fixed income, if you were to bottom of the page, total public fixed income goes to 20.5. Public equity goes up by, as Jim said, by 11.3%. It's a lot more concentration of public equity.
Now, can I just ask a question on this? Private equity, you can't flip a switch. And so the reality is that if we were to decide to eliminate private equity, we would still have a substantial allocation of private equity, likely for the next 10 or more years, like the entire period of this that we're anticipating with this asset allocation in order to wind it down, because these are very long-term partnerships that we're in. And so what effect does that have on, like you wouldn't be able to, if, our current target for equity, we said, was just under 50%. We couldn't just increase it because we're still going to have a very large allocation of private equity for the foreseeable future. So how did that get taken into account in figuring out this risk-adjusted return?
Yeah, actually, the answer to that question was just take the asset mixes here out of order. Excuse me. If you look at the far right-hand side, we have a 5% allocation to private equity. So that would be a reasonable expectation of what the allocation to private equity, given our current commitments, is going to be on average. It's a rough average, but on average, going forward over the next 7 to 10 years. And this shows the implication of having this residual private equity in the portfolio. And not too surprisingly, it's kind of a lower octane version of the no private equity 3 allocation. And so we see the same, the nature of the changes is the same, it's just that there are lower values. Publicly traded equity goes up by a little bit more than 3%. The fixed income is reduced, but instead of going down by about 3%, it only goes down by about 1%. And there's very little difference in terms of return and risk compared to the original target. So we still get close to 7%, and we still have about the same volatility. But again, that understates the value that we think that private equity contributes.
Larry?
Yeah, Jim, this is Larry Shum on behalf of the Public Advocate. But the case for 5% private equity assumes that there's a legacy portfolio that isn't academic, right? This is a portfolio that is pre-existing at this current moment, and by limiting the opportunities of reinvestment in those funds that have performed exceptionally well, we would be holding on to a legacy portfolio that may be lacking in its return characteristics, to say it nicely, but assuming certain return characteristics of a generalized private equity program. So, I think this is a good exercise, but I think the reality is that from what we've been told in terms of what the reasonable expected rate of return and risk on private equity is looking forward in the programs that the Controller's Office has been able to deliver in the last few years and a couple of years before, going forward, and not just 5% holding those which we have long-term commitments with. So would that be generally correct?
I agree with what you just said. One of the things about private equity, and I think I'm going to repeat what you said maybe in a slightly different way. One of the things about private equity that differentiates it from public equity, in addition to the liquidity, is that the private equity market requires that you continually invest. You're going to get cash flows back. You're going to reinvest those in the market, and that's important because there are sectors of the private equity market that will be in and out of favor. There are years in which private equity investments will be made that will be more or less profitable than other years. And to the extent that you let a private equity portfolio run off, what you have in that runoff period may not be as successful and is likely to be not as successful as what you have with an ongoing private equity allocation. So the decision to eliminate private equity implicitly says that the value that you've given up in having this runoff portfolio is worth giving up because the benefits of ultimately reinvesting these assets, most likely in public equity, offsets what you're giving up in return in terms of that runoff portfolio. So there is a cost to eliminating the private equity allocation, but you have to weigh that against the benefits that you get by changing the diversification of the portfolio.
Okay, do you have, Dave Katzman.
Yes, I wanted to ask about an aspect of risk which is not directly measured by the standard deviation, and that has to do with the concentration of risk. In a prior iteration, I believe it was in March, Carolyn showed us the asset allocations for numbers of large systems. And in those asset allocations, commitments to public equity, both domestic and international, tended to run about 45% of the total portfolio. We were at sort of the high end of that, we're around 49%. With the base 3, we would go up a little bit above 50%.
And more in domestic specifically.
And more in domestic specifically. And if we went into the no private equity, we would go up to as high as 64% by my rough arithmetic here. Now, I can't, not in a position to calculate this precisely, but by rule of thumb, my guess was that at 45% commitment to public equity, you have over 60% of your risk in the public equity basket. And then when you go up to 64% in public equity, you have north of 80% of your risk in the public equity basket. Because of the characteristics of the asset class. Does that sound roughly on the mark, Jim?
Yeah, certainly the risk associated with a public equity allocation, the contribution of risk by public equity to the total risk of the portfolio is substantially higher than just the dollar allocation to public equity. And
fees being considered in this analysis?
Jim, you want to
Your
cover that?
returns for all the asset classes that we show here are being shown net of fees.
Jim, do you have further, to present on the slides?
Yeah, the only other thing that I can point out quickly is that we skipped over to one mix, the no hedge funds, no private equity. And you get a kind of a combination of what you have from the prior two mixes. You get the reduction in return. It looks like there's no additional reduction in return by eliminating private equity after eliminating hedge funds. Really what it is it's rounding error there. Notice that, as someone pointed out earlier, given the lower allocation in the basket clause, or the removal of an allocation of the basket clause for both hedge funds and private equity, you are able to invest in non-U.S. equity in what we consider optimal way. But as I mentioned before, that optimal way, while a very diverse way to have exposure to the public equity market, means that the portfolio as a whole has a very large concentration of risk in the public equity market. And while there are distinctions between U.S. and non-U.S. equity, again, they're both public equities. They tend to have high correlations. They tend to move not only up together, but down together, especially in a crisis. So we would consider this a more concentrated portfolio than the other alternatives.
Okay. So are there further questions from trustees for either Callan or for BAM staff? Okay,
Just
Antonio.
going back to the international kind of equity split, like right now, our policy portfolio, if we're looking at it from just an international perspective, is overweight emerging markets versus the MSCI ACWI ex-US. And I wanted to get both, Scott, your comments and then Callan's comments on all else being equal. Do we think that that should change? Do we think that essentially our portfolio should not have a particular view on which equity markets are going to outperform, and that in addition that, with some like leeway with our kind of rebalancing ranges?
The default position and our preferred position would be at a market weight closer to 15 to 20% in emerging markets versus developed markets. The previous administration at BAM expressed opinion that they wanted to have an overweight to emerging markets. And so that's how we got to where we are.
So where I would come out on it, if you go back to the last asset allocation discussion in, what was it, 2011? You look at the expected rates of return and the expected range of return. And then you say, how did we do? What did we do? And this, Miles Draycott showed this to you at the last sim. And across most of the asset classes, we were at or slightly above what we were expecting. There was one asset class that we were a lot below, and that's emerging markets. So the equity. So the bet that the last administration made, I would argue, it may have been early. We've certainly gone through a regime where the markets have been hostile to emerging markets. I would argue this would not be the time to change and return to a neutral stance. In fact, if we stick to our rebalancing structure, we would be and have been buying more emerging markets equity. I don't think any of us can predict the shape of the markets, the direction of currencies over short periods of time, being less than 3 or 4 years. And so I think the expected returns are such that it makes sense to continue a strong position in emerging markets. But you know, when valuations are neutral, when you're fully you know, you've got the extra risk fully valued in the marketplace, there'd be no reason to be different than the market. But you know, I think the insights that the previous administration had, if they were correct in 2011, they're even more correct today from a very long-term perspective. But of course, it is a more troubled world in terms of places that we see growth, and there's some serious concern about growth in China and offshoots of China. Now, the way you all do emerging markets, you've had less exposure to China, and so you have had a more muted ride than others might have. But you know, I feel comfortable with an overweight to emerging markets.
And then follow up to that then is, you know, can that be? I mean, I don't know if this is veering too far in implementation. Can that be expressed, not necessarily through the policy portfolio, but giving, you know, BAM, whoever, like more kind of leeway with regard to the rebalancing ranges, and not necessarily saying that, you know, we have a, like, our overarching policy is that the emerging markets should be overweighted, but given, you know, our current, like, the current outlook could, you know, I'm not sure what our rebalancing ranges currently are there.
I mean, to me, and this is why it's best practice to do regular asset allocation discussions with the board. Every 2 to 3 years, not every 4 to 5 to 6 years, because the asset allocations are intermediate term allocations, and given where we are today, you know, emerging market equities, and Jim, you know, weigh in if you disagree with me, they're at extremely low levels of valuation. Now, there's, you know, as always happens when that's the case, there's a lot of controversy around them. But I think I'm comfortable, you know, with that time horizon, 2 to 3 years, maintaining an allocation that's overweight to emerging markets relative. Now, when you start taking, you know, private equities out and hedge funds and the other ways that we get the same type of return,
You have to essentially overweight, right?
You have to overweight, and in fact, you have to amp it up. And that we need to think about, and we need to go back to the comments that Dave made. You're almost getting to the point where you've concentrated all of your bets on public equities, and you reach a point where, you know, you might as well do without alternatives altogether, because you're taking that much of your risk in public equities. So you know, I'm comfortable where we are with an overweight in emerging markets. You know, we could tweak it a bit, but we don't want to get too carried away. And as Dave, I'm nervous about concentrating too much of the overall portfolio risk in the public equity market, which tends to move together, you know, other than currencies.
Okay, other comments or questions? Okay, so I think we're moving to discussion now. Honestly, I don't have a clear idea about how to do this. Let me just say that I believe that we are not planning to take a vote today because not all trustees are present. And the suggestion has been, and I want to, so that we know where we're going to end up at the end of this discussion, that we plan to try to get to a point where we're ready to take a vote at the next board meeting, which is 2 weeks from yesterday, I think, the 13th. 14th, thank you, the 14th. And so if that's acceptable to the board, I think we plan that to do it in conjunction with a regular board meeting. We might want to do it first if we want the calendar, but we can, I'll defer to Diane on how we schedule it. But does anybody object to planning the, hopefully the final asset allocation discussion for the board meeting on the 14th? Pat?
Well, I do not like the idea of discussing investments at the regular board meeting. I don't like that at all. I have appointments, but I can change them if everybody else wants to do this at the regular board meeting. But I was always concerned when we changed our procedures to go from a monthly meeting, and I don't mind this in being one group of 5 funds, which we had made it initially 4, and then it was changed to 6. That was better. But, so I would say I'll go along with it, but I really hope we don't continue to do financial stuff, investments at the regular board meeting.
Okay. Any other, John?
Can we just maybe do the investment, take care of regular business first, with a target, I don't know how, which is on that calendar for that day, but if we could sort of guesstimate, you know, the exact start time at 9:30, for example, and say, okay, it's going to take an hour and a half, a little leeway. Then, so this way we're not constrained in the investment meeting. I mean, if we need a longer time, it goes longer.
Okay.
But to have it again, and then be worried about all these other people standing out there that want to come in and make personal appearances. So maybe if we got that part of business done, and then we went to the investment part. When we're finished, we leave.
I think that would work better for
Okay.
disabilities.
Okay.
review.
Is it possible, though, that you'll have a sense of the calendar in advance so that BAM and others would know an approximate time of when we would start? It's not fair that they would
Yeah,
have
I
to be
mean, I
here for
don't
the other
see us
part.
going that much through lunch. you know.
Okay.
If you wanted to say like maybe 2:30, something like that, would commence the investment
Schedule
component.
2 o'clock.
Something like that. I mean, we'll see how many disabilities we have as we get closer.
Yeah.
Okay. So we'll put out a notice about that when you have a sense of disabilities. Okay. Is that a hand, John Dorson?
No.
Okay.
Just wait.
Wait, hi, John. Yeah, okay. Okay, so let's move to discussion and get, I think where I'd like to go is to get a sense of where the trustees are vis-a-vis this discussion, what you're thinking about. And so the floor is open for, views. Or non-views. Mr. Garrido.
So, I think Einstein defined that as doing the same thing over and over again and expecting different return. And maybe that's an exaggeration in this case, but to me, I've heard a lot of discussions about status quo to some degree because it's probably the safest. I think it's time that we begin to look at things different. And I'm not one to, propose the complete reconstruction of a very well thought out portfolio by Calvin and Scott and the team. But I do think that within those alternative investments, I think people in this room pretty much know how I feel about hedge funds. And so, for those who don't, let me reiterate, I think it's insane that we keep pouring money into hedge funds. High fees, it's one of my problems. I think that it is not a good prudent investment for this, from the fiduciary point of view. I get it that it doesn't make a large dent perhaps in our portfolio, but I think that, what we do here is take what we have in front of us and try to do to the best of our ability, try to project what we think would be a better investment for the people that are the beneficiaries of this fund. And I just want to reiterate what I have said. For the many reasons, if it doesn't make, based on the actual accounting report, that much of a difference, and we're seeing what we're seeing, I just think it's time we'll get out of hedge funds. I don't want to comment into the other alternative assets because I do have feelings about those, but I think for now, that is where I stand.
Okay. Other points of view? Pat?
Yeah, I had a
question, actually. If one had an asset manager over a 3-year period of time who didn't perform well, I would posit that we would probably decide to remove that asset manager from our investments. But when you have hedge funds, and it's maybe like an adolescent's idea. We don't have hedge funds for that long. And I would think we need more time. I would never say that we should not remove hedge funds from the portfolio. However, I think it's premature at this point to remove hedge funds. And last year was a particularly horrible year. Basically everything. 2015 was a bad year. So I would hang on to everything. I like it the way it is, actually. And these explanations and these meetings and what Callan has done has only, made me understand things better. I really appreciate all the information. So I don't see any reason to change anything from where it is at this time.
Okay. I actually just want to ask a question. All of these, well, no, not all of these contemplate a reduction in the target to private equity. All the ones on slide 2, from a current target of 8 to at most 6.9%. Do you know what our current exposure in terms of invested capital is to private equity?
Yeah, I believe, I don't have it in front of me, but I believe the target is 7 and the current exposure is closer to 8, just the way that the market is moved. Still within bounds, but it has to do with the underperformance of equities during the period of time relative to private equity. But I believe that the allocation is 7. I could be wrong about that.
So if we...
So it would be, sir, you think that's right?
Yeah.
Yeah, and so the 6.9 would represent, a flat commitment. And to the point that Jim was making about, having diversity across vintages, as cash flows come in, we reinvest them in new vintages, and to Larry's point, into stronger funds, basically improving the mix of the portfolio and improving the chance that we have positive PME spreads.
Okay, so that was really my question, was would that reduction affect our ability to continue to invest across vintages? And your answer is no.
Well, not unless you eliminate PE, then it would.
No, I'm saying if we went from 8 to 6.9.
Yeah, no, the 6.9 would not affect it at all.
Okay, thank you. Madam Public Advocate.
In looking at the alternative asset mixes, why did we not look at limiting hedge funds to 5% as we did with private equity?
Well, that's above where we're at now, right? We're at 4% now, I think.
Mhm.
So if we were to reduce it below 4%, or something less than?
Well, I think the reason they did that is that unlike private equity, where your money is tied up until the partnerships wind up and they sell the companies and then they send you distributions. Hedge funds are like mutual funds. They have some restrictions. You might have to wait till the end of the quarter or even till the end of the calendar year before you can redeem your funds. But you can redeem your funds, unlike private equity or private real estate or infrastructure, where you're basically in for the long haul. So you have the flexibility to take your hedge fund exposure down as far as you want. And so the reason Jim did the last column was because we don't have the flexibility to take our private equities down.
And then the other question is, base 3 without hedge funds or private equity, what is the concern again about having a high allocation to public traded equity?
So what you want to do, I'm sorry, does Jim want to? I'll take it, and Jim,
Okay.
if you want to add anything to it. But the principle in portfolio theory is that we have to take risk. If we're going to get to 7%, that the actuary believes we can get in the market, and I think it's realistic over a 30-year time period. You want as many different sources of return as possible, because if you can take risk that's going to make you 7% or higher. But the ups and downs come at different times. Then it smooths out the overall performance of the portfolio over time. It smooths out the ride, and it smooths out the need to, make huge contributions or to have a volatile contribution stream. So having different sources of risk is very important to a portfolio. And the point that Dave was making is if we get rid of hedge funds and private equity that are different sources of return, they're similar return, particularly private equity and public equity are similar sources of return, but they're somewhat different. You concentrate the risk in the portfolio towards just equities, just public equities. And all pension funds, in fact, all large financial asset portfolios that are trying to earn similar rates of return rely more than we'd like them to on the equity markets, but there are very little choices. So if you say we don't want to do hedge funds, you're really limiting a scarce resource, which is something that's going to earn you a similar amount of return over time, but with a different pattern of behavior.
And if you were to maintain the status quo, is there any way that we could, pass a resolution which would limit what they invest in, like for instance in private equity in terms of over-leveraged real estate?
You have the ability in your investment policy statement to shape the mandates however you'd like.
Right.
So that's not really the issue. The issue is, do we limit ourselves in terms of the managers that we can hire? So if you look at all the people that are likely to make us money with a given type of return stream, if we limit them too much, they may say, you know what, that's just too different from what we do, and we don't want to play. The place that I think we face that the most is in the emerging markets area, where we don't want China, we don't want a variety of countries, and so we have to pretty much limit ourselves to passive mandates where we can carve things out. And the issue we're starting to get to is, as we do this screen and get closer and closer to taking other countries out, we begin to ask ourselves the question, are we really participating in this asset class or not, sub-asset class? And so I think that's the issue. If you make too many restrictions on the portfolio manager's mandate, you might limit the portfolio of or the selection of managers that you can employ. But that is a tool that we do use. We have a responsible contractor policy, which we ask all managers to abide by, and it's particularly important in the real estate industry. It is an example. So that you do have that power.
And one
Scott,
other example would
sorry.
be opportunistic fixed income, where we have a leverage constraint in the IPS. So there are, that puts a governor on the managers in terms of the amount of risk they can take.
Is it possible at some point in the future to look at the mandates that we currently have in place with respect to each asset class?
Sure, we do that. We do that regularly on our reviews, and after we get done with the asset allocation, the game plan, as Larry knows, is to bring each asset class and to also bring the investment policy statement and take a fresh look at it and say, do we have instructions to these managers that we're comfortable with? And I think an issue that we really need to look at, because we have layer upon layer upon layer of history in the investment policy statement, is there a sort of more clean way that we can frame it? So that's coming once we make a decision on asset allocation.
Thank you.
Scott, I think I want to take issue a little bit with your description of the role of hedge funds in our portfolio, because my understanding, you really describe them as sort of part of the equity driver for return. And my understanding is that they're really more about risk. And 50%, as I understand it, of the allocation is for risk. Diversifiers. Thank you. And 50% are return drivers, right? Is that right, Neil?
Yes.
Yeah. And So they're really, as I understand it, not so much about increasing returns as they are about, you know, risk-adjusted returns where, you know, for example, one of the qualifiers that I've heard is that one of the reasons that the hedge funds have not performed as well since we started investing in them in 2011, I believe, is because it has coincided with, until this past year, a boom in equity markets, in most equity markets.
Yeah, I actually don't think we're saying different things, John.
Okay.
Let me try to explain. I'm saying that with hedge funds, and I'm going to broaden it, with opportunistic fixed income, with high yield, with emerging market equities, we're taking risk. We're taking equity-like risk, and we expect to be compensated for that risk. But the risk has different patterns in it. In hedge funds, we're looking to mostly get alpha risk. We're looking to get risk that is not tied to the market. And hedge funds, by their very nature, you know, have long and short positions. And so if you have a perfectly matched long and short position portfolio, and there's no alpha, there's no extra value, the expected return would be, you know, treasury rates, right? So when you look at the riskiness of that portfolio, it's very separate from the risk that you find in the equity markets.
Right.
So you would not expect the return that you're expecting to present itself at the exact same time as the equity markets. So it's not correlated. It's not correlated risk. And in fact, if we want to map what the overall volatility and correlation looks like with the type of hedge fund portfolio that we run, that runs about a 0.2 beta, you know, so 20% rather than a pure equity portfolio would be, you know, 100% or 1.0 beta. It looks kind of like half equities, half fixed income. But fixed income. But make no mistake about it, we expect over time to earn returns that are in the same neighborhood as equities.
That's not what our benchmark is, though, right? Our benchmark
is
Treasuries plus 4, right?
Yeah, and so if you look at the equity markets over long periods of time, is that a Treasury bills plus 4, right? Yeah. If you look at the equity markets over long periods of time, 5%, 6% over Treasuries is about what you get. So you're right. We're expecting a little bit more raw return from equities over time, but it is a risk asset, as high yield bonds are a risk asset. We're taking risk, but we're taking them in different ways. And one of the ways you can see is by you know, if we want to kind of map what the behavior is going to look like, it looks like about half fixed income, half equities. So when we say over a 3-year period, are we doing better than the market? We have to say, are we doing better than the market at 50% and fixed income at 50%? Now, I would invite Jim Hewitt or Jim Voss from Maxey or Neil to correct anything I've just said, if you want to, or Mike Cadet, if you want to amplify on that or correct it in any way.
I mean, maybe the only thing that I would add is that, you know, the annualized volatility of the hedge fund portfolio is, even at a 50% equities and 50% fixed income, it is still probably half of that. So the risk in the hedge fund portfolio is significantly less than that of you know, any sort of public markets benchmarks or indexes that you choose to use.
The volatility is
Yes.
less, yeah.
And one other thing I would point out in this discussion and if I get this wrong, I'll ask Sherry to correct me, is that we already have a volatility reduction through smoothing, right? So we smooth, in terms of calculating our contributions and calculating our actuarial value, we smooth our returns over 6 years, right? And so, which is already a sort of volatility reduction regime that is central to how we calculate the value of our fund. Is that an accurate statement of that, Sherry?
Gain losses or issues,
Right.
and then we amortize that smoothing over 15 years.
Over 15 years?
That's why we did the exercise with Sherry, looking at the low-cost portfolio, so which is the sort of pure example of this, which is no alternatives, which
Right.
Pat was asking about before, and that puts almost all the risk on public equities, and it presents a lot more volatility. But we say, okay, can we live with that volatility because we smooth? And so Sherry showed you what the effect would be if we have just a horrible scenario, 5 years in a row, the worst markets we can dream up on the computer, and it would be much worse than the financial crisis we just lived through. And Sherry shows you, what that would mean in terms of extra contributions that would need to be made in the annual required contribution case. So that's sort of an extreme case. If you took something short of that, you'd get a more muted response.
Pat?
Yeah, the only thing that I would add is that we actually have, at least implicitly, taken into account the smoothing. If you didn't have this asset smoothing that feeds into the contributions, having a portfolio that had 13 or 14% standard deviation would lead to just intolerable levels of contribution volatility.
Okay, Pat?
Jim, do you want to just repeat that? I think
Yeah, I'm
the
sorry,
last
Jim.
piece of it
Could you-
drowned out a little
yeah.
bit.
Oh, okay. Sorry about that. No, I was saying that we have at least implicitly considered the fact that the asset values are smooth by saying that portfolios that have let's say, a 14% volatility are acceptable. If we had no smoothing, having a portfolio with a 14% volatility would lead to just intolerable volatility in the contributions that would have to be made to the fund.
Right. Thanks.
Which is why corporate plans utilize long treasuries more often than public funds.
Yeah, and corporate plans take a totally different approach to. They don't use a expected return approach. They and it's a different exercise. So the bottom line here, even with this, we're taking a lot of risk, and we're at the edge of the risk spectrum among public pension funds. Right, we would be one of the riskier, most aggressive portfolios in the public pension fund space.
We're slightly above median because a lot of people also have to achieve their 7 or 8% return, and that requires a lot of equity.
Right. Let me restate it. Our reliance on public equities is already at the very high end of
And specifically U.S. equity.
Right.
And specifically what, Tom?
U.S.
U.S.
equity, because of the basket clause.
Yeah.
So it's not just the public equity, it's a concentration within public.
So if you were to go, just to follow that thought, if you were to go to a no alternatives mix, you'd really, you'd be really up there.
Pat?
Just a comment. Scott, the other day when we were together on Wednesday and listening to presentations from Roberton and Cal, and you brought up the constituencies, our constituents, and if we had a very volatile portfolio, because we chose to go away, eliminating the alternative add-on, our pensioners and those who are contributing and the city, plus Mary Williams Walsh, who writes these columns that rip us to shreds in the New York Times, that would be very, very difficult to live with. And, they're always being the bandwagon to do away with the defined benefit, and, that would be horrible. So this very volatile portfolio would really be a problem.
there would be almost certainly more volatility in the portfolio.
Henry?
You know, I seem to recall some report going back to September, October last year regarding fees and the fact that we were not getting the best returns. And as I recall, there was some analysis, I think they shared some information about how the concentration of those fees, exorbitant fees, as I recall, was what the report talked about, was on basically 3 asset allocations, right? Private equities, hedge fund, and real estate. Maybe rightfully so. At the time, I seem to recall, I think an analysis that was done by the New York City Controller that looked back 10 years and essentially kind of outweighed the heavy amounts of fees versus the amount of returns. And in fact, that in some cases was negative, right? Once you added all of that. And yet I'm hearing today basically that we're asking us to continue a system that would pretty much mimic that. So in terms of volatility, what Pat said, for the people I represent, I think that we ought to look at what we have right now, because it's not just about volatility, it's also about continuing to invest into something that is not making sense, in my opinion, and continue to pay these exorbitant fees within asset allocations that are not really yielding any kind of a value return. I think that from a fiduciary point of view, also from the perspective of protecting our pensioners and the people I represent, it's also an exercise worth doing. And it shouldn't be just worth doing it for the purpose of, well, maybe we exercise the demons of September of 2015. I have heard a lot of discussions, and I appreciate all the presentations and certainly the patience with me in terms of questions, a process that I'm beginning to learn a little more each day. But I do think that this stay the course principle that I'm hearing, or at least that I'm getting as an idea, is not something that I consider to be, I don't want to say responsible, but I don't think it's the right way to do it, since we just didn't have one full year. We've had good years over 10 years, good investments, good management on top, and even with all that, there are some assets applications that are not performing. And so I think what led to this analysis was not just the fact that we've been through 3 years, it's the fact that, our return was not what you expected. We were significantly below the 7 mark, and maybe that was unrealistic to begin with. But I think this is our time to really look at this and say, just not to our pensioners, but our taxpayers too. And I just would warn or caution that for the sake of us keeping this idea of the fear of volatility or outweighing this portfolio, that we don't really look at what has transpired for the last, a few years. That we just don't see this, well, this is a blip, we're coming back. Because even after 2008 and the market performance and everything else, we are significantly below that benchmark. And I would be concerned as just basically continuing along that course. And I'll leave it at that. Larry?
Yeah, so we had, excellent points about how I think this board, first of all, I want to thank Callan and Baum. I think people, we're on camera, but I think people across the United States should look at this as an example of how a board should be really analyzing its investments, and not everyone does it intensely in this. And I think the important point that is, there are trustees here who over time have seen certain asset classes that have had problems, both on fees, both on the way in which they treat labor, but this process folks were able to ask really pertinent questions and feel comfortable that if they were to select an asset allocation that withdrew one of those asset classes based upon fiduciary standards, that there would be a good outcome that would be consistent with the responsibilities here. And Callan just presented multiple options that maintain a standard deviation within our acceptable range and an expected rate of return within our actuarial projections. So by suggesting that certain asset classes need to be removed, and looking at those options, I think we are able to do that and feel comfortable about doing that. And that was something that when you begin a process of saying these assets may be problematic, but they add value, we have to look through. And this is something that I think has been done exceptionally well, and I think it'll enable us to vote accordingly, understanding what the ramifications are, and actually lack of ramifications in terms of projected returns by removing certain of those assets. I did want to ask one other thing. Scott, you had mentioned that we will look at the IPS individually the assets. Each of these assets, that some of the private assets, real estate, private equity, and in hedges that we continue to have relationships with, we have some of the international exposure, certainly, even on the emerging markets side. I remember one that had implications in China. Because we're increasing our international exposure, if we were to select certain of these, would it be the expected thought to look at how those portfolios are constructed because we'll be having higher exposure perhaps to international equities? Would you then look towards those? I mean, that's not a conversation we have to have today, but I just think it's important to note that there are ramifications towards removal of certain asset classes.
Yeah, I think that the public equity, for all the reasons that we mentioned today, the public equity asset class will be one of the first that we look through. And for you all, the emerging market asset class needs to be looked at very carefully because of some of the issues that have been discussed on an ongoing basis in terms of the IPS and how we execute it, particularly if we're going to be increasing an already overweight position in emerging markets, as would be suggested by taking some of these alternatives out. So we would do that early in the process.
But like, for instance, private equity would, as an asset class, we would
look at all of them.
If we're having higher international exposure, then that may not be something we necessarily want to portfolio, private equity portfolio. So that's just something, that there are implications with the other asset
Yeah,
classes.
well, depending on what you all decide,
Right.
we'll do it in order of immediate
Well, thank you.
importance. Yeah, sure. And we'll obviously discuss that with you, make sure you agree with us.
Okay, are there other points of view that trustees would like to express on where we're at with the asset allocation?
And I know this is just for Jim, but looking at overall, like on the page 2 of the current the deck for today, ultimately, the difference between total public and private equity exposure taken as a whole between the base 3 recommendation and the one with no hedge funds and no private equity is about 5.5%. Can you translate that into how much equity risk reduction that actually ends up being? Like how much, because, obviously, private equity really is just, levered equity, still exposure to companies just in a different, in a kind of a different way. And then, even our hedge fund exposure will have, some equity components. Our exposure holds, 0.2 beta, but that 5.5% difference, what does that actually translate to in a ballpark figure in lowering our concentration to equity risk?
Yeah, I'd have to actually do the calculation to tell you something precisely. But ballpark, net eliminating the private equity allocation and reallocating that to public equities plus the additional public equity exposure that you get because you're reducing the fixed income risk hedge to private equity, you're probably not reducing your generic equity exposure very much, if at all. As Scott pointed out, private equity, while equity has different sources of return, as you know, from the public equity market. So by eliminating it, you're probably actually, you're certainly increasing your exposure to the public equity market and probably disproportionately increasing the exposure to the public equity market in relation to how much you're reducing your exposure to private equity.
'cause I think that overall, if we're thinking about, if, breaking down each of the asset classes, if we're thinking about, and our worry is always kind of our concentration in equity risk, it's, ultimately, what are the differences in that particular concentration? Like the 5.50% that's kind of on the bottom, obviously is not a complete representation of both, our exposure to equity from a risk standpoint. And so I was just wondering if, and maybe we can, talk offline or get something out, like just ultimately after this is all done, it's like, what are equity risk, what are our credit risk, so for like between each of these particular portfolios, because I imagine that a 5.50% asset reduction in equity risk does not translate to analogously to a that level of reduction in our actual volatility concentration, and so just wanting to think about that.
Yeah, no, I absolutely agree with that. It's certainly not one for one, and there are trade-offs involved,
Mm-hmm.
and a reduction of the private equity exposure does not necessarily translate into a reduction in exposure to equity risk.
Mm-hmm. Thank you.
Not at all.
Okay. Other trustees who would like to weigh in on sort of how they see this at this point? We're not voting, this is not a commitment, but I'd be interested in people's perspectives. Alderman, who, let me note for the record that Alderman Bonilla, Manhattan Borough President, arrived a long time ago.
Can you walk us through a little bit of the increases to international equity or the emerging markets? How does that play itself out in terms of opportunities for us, so that we have issues of country screens, we have the market growth and economic projections that you've given us for Europe and for the Far East. We have the issues with Brazil and Russia. So what effects will that have for us in terms of opportunities, given the economic outlook and the country screen and all the above?
So we dealt with this earlier. It might have been before you got here, Robin. But were we to get out of some of these alternative asset classes, you can see there would be an increased exposure to international markets. As is pointed out by Callan, while we're overweight emerging markets, we're still not, to market weight in the mix between U.S. and international. So we're kind of in an underweight position, for instance, in Europe and developed Asia, IFA. In the emerging markets, you would increase the bet. And you're increasing a bet where you have there are two sides of the coin. Yes, there's more risk. There's been a lot of currency risk. There's been a lot of concerns about the developing world's ability to grow in an environment where we're having as much trouble growing in the developed world, where there was so much reliance on commodities and on infrastructure spending and sort of heavy growth in the export sector, as opposed to consumption in the developed world itself. So there's a question about how much those markets are going to grow over the next couple of years. The good news is they're a lot cheaper because of that concern, and so you're just mathematically, from an expected return standpoint, you stand to get paid for that risk. You stand to make more money because people are pessimistic. Whether that'll pay off or not, we don't know. But we would be increasing our exposure at the time that we're not paying as much for a dollar of earnings as we usually would because of these concerns. And we're already overweight emerging markets. I've expressed comfort in being overweight emerging markets, but pausing when we talk about ramping up that bet a lot more, which would happen as you exited some of these alternatives, because again, you're sort of concentrating the risks that you're depending on to get you to the 7%. And we're always more comfortable because we're very bad at predicting the future, all of us. We would like to diversify that risk a bit.
The overweight in emerging markets, that includes with BRIC as well?
Yes.
All members of BRIC?
Yeah. Yeah, no. But you're, all those countries are included in the emerging markets. You don't participate in all of them because of your policy.
For us,
So,
it's just B.
yeah.
We get the Rick.
Right. But what you end up with is a, much more concentrated, we're overweight in emerging markets. And you're doubly overweight in the outside of China and Russia and the other countries that you exclude. So you're already really overweight those countries, and you would be increasing the bet again. We'll trace that out for you, particularly when we go through the equity portfolio. But yeah, you're putting more of your chips on the same number.
And has been alluded to here before, is the next step after asset allocation is the structure within each asset class. And so we would get into decisions of how much in emerging markets versus developed, how much active versus passive, how do you construct the underlying managers between growth, value. Those kind of things would be the next level of discussion on equity. And then in fixed income, it also would include high yield bonds and bank loans and other things that make up your fixed income portfolio.
Antonio? So given that decision, so should we then look at your current recommendation, let's say in base 3, just kind of add up the total international exposure together, and then we dice it up in implementation? Okay, so think of it more as we're thinking 16.9% in international, and then post that, thinking about how we divvy that up.
That's fair.
Okay.
Yes.
Thank you.
Thinking about it that way, change because under that assumption, then you can kind of reconfigure the different, within each general, broad speaking class, right? The different allocations. Does that change the underlying risk numbers at all, or projected returns by doing it that way?
It may slightly.
When we go into the sub-components of each broad asset class that's making minor variations in their relative weights, does not have a significant impact on either the expected return or the expected risk.
Okay, further perspectives that trustees would like to offer this morning? Okay, so unless there are further comments or questions, I think we should wrap it up for today. Do you need to formally adjourn? Okay.
Motion to adjourn.
Motion to adjourn, is there a second? All in favor of the motion to adjourn, please say aye. Aye. Opposed?
Sorry? Yes.
Abstentions. Okay, meeting's adjourned. We'll reconvene
Yeah,
at
because then,
the board meeting on April 14th.
Larry's back.